You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
A recent headline one of my other guests said would be appropriate for this year is 2015 will be the year of panic. Is that an accurate kind of headline?
Well, I think it certainly could be. We're in month, I think it's 71 now, of the longest extension of a 4-year cycle top ever, or into a 4-year cycle top ever. And you say, well, how in the world, a 4-year cycle that has gone 71 months? And by the way, cycles are measured low to low. I mean, historically, since 1896, the 4-year cycle has averaged 48 months from low to low. Well, we haven't, unless we saw the top yesterday or today, we haven't even gotten to the top yet, and we're in month, I think we're concluding month 70 with February. And so this thing is extremely stretched. And, I said when the rally out of the '09 low began that it was a rally within the context of a secular bear market. And I believe that 100%. People confuse the fact that we're at a new high, and it's just hard to wrap your mind around the fact. And you say, well, we're at a new high. How in the world can he say it's a bear market? This guy's crazy. Well, no, it's about the technicals within the market, the volume characteristics. It's about, it's far more than just the price high. Let's put it that way in simple terms. And an example of that is everybody is familiar with the 1966 to 74 bear market. Richard Russell, in fact, called the bear market bottom using Dow theory just weeks after the bear market bottom in 1974. So there's no dispute about the 66 to 74 bear market period. Well, what people don't understand, because they don't know history and they don't look at charts, is that the rally out of the 1974 year cycle low carried price to a new high in early 73, to a new all-time high before it collapsed into the bear market bottom in 1974. And so the price level itself is not a determining factor of whether or not you're operating in a true secular or bull or bear market. So, and people may say, well, what's the difference if you're at a new high? Well, there's a big difference. And the big difference is the health of the market and the sustainability of the rally. And this whole thing, just like that rally out of that 1970 low, this whole thing is built on a house of cards, but even worse than that rally because of the level of, manipulation and then things that have happened to fuel this thing, that we didn't have then. Back then, I think it was just based on, optimism and people thinking that the bear market had ended, and hope. Well, this time it's based on all those things, I think, plus the liquidity campaign, the global liquidity campaign that has pushed it and extended it into, like I said, the longest 4-year cycle advance ever.
And wasn't that the period, too, that Nixon took the U.S. off the gold standard?
During that period, yes, he did. Yes, he did. And one other thing I want to add here is that people never see around the corner. They can't. And there's data to that. There's everybody, the buzz I hear is everybody's bullish. Everybody thinks everything's okay here. And, we're at a new price high and everything's fine and Dow's even going higher. And it may, until we get the setup to cap it. I keep talking about that. And that's some specific stuff we're looking for. And when you go down a checklist, you go, okay, we got this, and you get some structural confirmation. Then we have something where we can say, yeah, this thing's done. And right now, it's like walking through a minefield, but we haven't seen that setup just yet. I mean, it's tried and tried and tried throughout 14, but it never stuck. Well, anyway, I'm getting sidetracked with that. My point is people never see around the corner. And an example of that is that according to the investors' intelligence data, people are more bullish right now than they were at the '07 top or the 2000 top. And the numbers were extreme at those tops. And the point is that because everybody thinks something is so, doesn't mean that it's so. Because they thought that things were great at the 2000 top, obviously, and the 2007 top, according to those numbers, and they weren't. And they think that everything's okay now, and I'm telling you that they're not, and time will prove that. But then we were talking about the rally into the 73 high. Interesting when you look, it's hard, the fascinating thing is when you look at history and facts, it's hard to argue with history and facts. And so, talking about that rally out of the 1970 4-year cycle low, which was the decline that separated phase 2 from phase 3 of that bear market according to Dow theory, we had the rally out of that 4-year cycle low in 1970 that carried price to a new high. And I want you to know that it is a fact that the investor intelligence sentiment readings were higher at that top than even what we see now, much less the 2000 or the 2007 top. And so people always get it wrong. They always get it wrong. Nobody sees the top. Nobody sees the bottom. And there you were, in a classic Dow theory secular bear market, just as we are now. And nobody got it. Either they didn't believe it, or they chose not to believe it, or I don't know what the problem was, but they all got it wrong according to the numbers. And then the market collapsed to a new low from a new high to a new low for the secular bear market, and finally got the washout bottom into the 1974 low, and nobody saw it coming. And I'm telling you, that's what we're seeing here.
People are perhaps thinking computerized trading now will be able to catch this. I'll put a stop loss in. There's no way I could lose money like people have in the last collapses in the equity markets, because the technology will protect me. And they're used to central banks stepping in. But now with the central rate in the U.S. being 0, in Canada, the central bank cut the rate here to less than 1%. Where could they help you? What could they do to manipulate it to help you out? They've gone as far as they can.
I think you're right. I don't see, what else can you do at this point? And the other thing is that technology, I don't think it's changed drastically since 2007, and that technology didn't prevent, nor did the manipulation back then, and they had room to do things that I'm not so sure they have to do now, because I feel like, like you said, it's like they've, what more can you do at this point? But anyway, back then, we had the same computer technology we have today. 2007 wasn't 1950. What's really changed technologically as far as computerized trading, and did that prevent it? No. Was the Fed's headroom that they had then and the ability to step into the market and fix things, did that prevent the worst decline since the Great Depression? No. And the same thing's true here. Now, yes, they did a fantastic job at extending this thing, and I think the public is part of that too, because that they have the perception that everything is okay, and so they buy into that, and so you're seeing that optimism. I think that's part of why this cycle is extended and stretched like it has, as well as the manipulation. I think it's twofold, and once the setup comes, and the worm turns, as you would say, then I think it's that technology is going to lead to a stampede. And I think the damn thing's going to fall so hard and so fast that people are just going to be run over like a steamroller trying to get out of it. And I don't care how long, if this rally stretches another, it's not about price level. It's not about the price level. It's about volume. It's about the technical characteristics. It's about the structure. It's about valuation. It's about the phasing. It's far more than a price level. I don't care if this market goes up another month or another 6 months or another 10 months. It's still a bear market rally. You still look at the volume bars. I was looking at the volume bars. This rally out of the February low is occurring on shrinking volume. And people want to say, well, this time is different and volume doesn't matter because of the ETFs. And they want to give you all these reasons why this time is different. You know what? If you buy the ETF, the underlying share has to be bought. So that people try to justify in their mind something to explain the abnormal, and there is no explanation. It's abnormal, and it is what it is, but they don't want to accept that. And so, eventually the setup is going to come. We're looking for it. When it does, I mean, you couldn't hold a gun to my head and make me change my opinion, because I'm looking at hard data, just like those, the statistics with the sentiment stuff. I mean, data is data. I mean, it's like going to the doctor and getting a blood test. If it says your cholesterol's high, then damn it, your cholesterol's high. There's no debating that.
And also, too, people who take a look at cycles, they say when oil takes a big drop in price, about 6 months later, you see the equity markets collapse as well.
Well, there is a relationship, and I've done some work on that as well. And what it shows is the way I did it was a dollar oil relationship, and I don't have that chart in front of me at the moment. But yes, there is a correlation there. It's not a timing tool per se, but in general terms, that is correct.
We'll have more with Tim Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Tim Cyclesman Wood. Tim, you said when the rally began, the longer the rally lasted, the more convincing it would become. So people really are believing what they want to believe now, aren't they?
Yes, and what I said about that is that I knew that we had a 4-year cycle bottom, and I knew that it would last, for some period of extended period of time. I knew that it wasn't a 6-month rally. I knew that it would go for, I expected maybe a year and a half or a couple of years or whatever. And it's not double speak. It's in every interview I've done since 2009, and it's in the newsletter and every single copy since then. I said that it's going to also go until we get that set up. And so that hasn't happened. Like I said, we saw it try to happen a few times in 14. It's trying to happen now. Until it actually materializes, then it hasn't happened. And so the rally has extended. And yes, the more it extends, the more convincing it becomes. That was a profound statement. I didn't understand. I certainly didn't think that we would see the longest extension of a 4-year cycle ever. I did not expect it to take it to a new high, but it has. And that statement is a pretty darn profound statement that the more convincing, the longer it went, the more convincing, or the longer it lasts, the more convincing it would become. Because, like I said, right now we're seeing the most bullish sentiment readings, or more bullish sentiment readings than was seen at either the 2000 or the 2007 top. And the thing is that I feel like you're talking about all of the ammunition, if you will, that the Fed has spent on extending this thing, and like I said, my hat's off to them. They've done a tremendous job with that. But in the other side of that coin is that history also shows, in fact, figures, statistics, that the longer you stretch these cycles, the worse the downside into the next low is. I mean, it has to snap back. I mean, there's if you will, like a reversion to the mean that happens. And, it's just like, the 2007 top, that was the longest extension. Well, it tied the 87 top, but the 2007 top and the 1987 top, those were the longest extensions into 4-year cycles until this one. And look how they ended. So it's a fact that there is at least a tremendous risk. There's a precedence. There's a statistical precedence that the longer you stretch these cycles, the worse that revision to the mean is. So on the one hand, while they have done a good job at stretching it and putting off the inevitable, it has happened within the context of a secular bear market, and there will be a snapback once the setup comes, and it's likely to be, based on these statistics, quite dramatic. And at this point, I'm not so sure that it's, back in 2007, it wasn't even on my radar screen. It was just, hey, we got an extended 4-year cycle. We're going to go down. We're going to go down hard. And I said that it would go below the '02 low, and it did. And everything, it was just about the stock market. But this time, this scares me. And because I feel like that we're playing with something a little more dangerous here than we were at the '07 top. And, I think this is more global in nature, and I fear, this not only the economic, but the social and political consequences of this. I think we're literally dealing with just a house of cards in many ways, a time bomb waiting to go off, if you will.
Well, they're having deadly riots in places like Mexico and Venezuela. They say they're for social reasons, but if people don't have enough money and don't have enough to eat, what could be more social than that?
And that's the kind of thing I could see coming from this. That's what I'm alluding to. And nobody sees this thing coming. And to me, it's crystal clear.
So what should the average investor be doing to protect themselves from what looks like is going to be a horrible mess?
People are going to have to get their minds around that for themselves. There's a number of directions you can go with that. I don't want any part of the market here at all, because while we haven't had a setup to confirm any sort of a top at this point, I know how extended it is, and I know, like I said, what is going on with like the volume characteristics with the market. I understand, the underlying stuff that we've talked about before, like the velocity of money and job participation, the underlying economy, the extension of the 4-year cycle, the statistics surrounding it, and it's like Russian roulette. And so I know what the outcome is going to be, and as stretched as it is, I just don't want no part of it, personally, at this point. And the other thing is I don't know if people, if you want to try to squeeze every bit out that you can out of this thing, are you going to be able to get out? And then what happens is to people, and this is a prediction, because this will happen to somebody listening probably. What'll happen is they're in the market, it cracks, and it cracks hard. That's what, I guarantee you that's going to happen. And then it's down 10%, and they say, well, I can't get out now, I'm going to get out when it bounces. And the bounce doesn't come. And then it's down 15% or 20%. Well, it's got to bounce, and it doesn't. And that's how people lose everything. And that's the risk to this. That's the risk to this. And knowing these statistics, that's why I don't want no part of it. And knowing these statistics and knowing how I think, based on history, that this thing will come unraveled, that's why I've been saying that this is the most dangerous, because it's the most extended. I feel like, and again, given the circumstances in which it has occurred, the rally has occurred, I feel like that it is the most dangerous stock market environment since the inception of the averages in 1896. I believe that.
Tim, thank you very much for chatting with us, and I hope people are paying attention to what you've been telling them for the last 6 months.
I hope so, and I don't want to sound like a broken record, like I said, but it is what it is. And people they've been giving ample opportunity to listen, to do some research, and, not to sound like a salesman, but anyone wants to read the facts for themselves, that is available in the research letters at Cycles News and Views.
Thanks again, Tim. My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.